I'm Tim from Sonnet, the Money Saving Chartered Certified Accountants, and this is yet another one of our money saving tip videos. Today I want to talk about the annual investment allowance, because just a few days ago when this video was recorded, the 2018 budget happened, and they announced that the annual investment allowance was going to be increased quite significantly. My experience, though, even accountants seem to misunderstand how to best use the annual investment allowance to bring about the best tax advantage for you. So what is the annual investment allowance? Well, usually when you buy an asset, say a piece of machinery, then you have to spread the cost of that, take it off your profit bit by bit over roughly the period of ownership. The tax way of doing that is called capital allowances. But to encourage investment, the government say, they will allow you to take that straight off your profit in the first year. Now, in the 2018 budget, it was announced starting on the 1st of January 2019, the annual investment allowance will be £1 million. Now, don't get too excited, because how many small businesses actually spend £1 million on capital items in a year anyway? And besides, it is a postponement of tax. It's bringing forward the tax advantages, but you still have to pay the tax. So what does it mean really for a small business, the people that we at Sonnet are primarily involved with advising? Let's give you a worked example to help you understand. Let's say you spend £100,000 on a piece of machinery or a piece of equipment. Under normal circumstances, the capital allowances rules say you can take 18% of that £100,000 and take that off your profit. The next year you have to take 18% of the remainder, and so on, until you either dispose of the asset or it turns into a tiny amount in this complicated asset pool that you need to use. So for corporation tax, that would currently give you a tax deduction of around about £3,400. If you're a sole trader or in a partnership, then that could potentially give you a tax deduction maximum of around about £8,500. However, with annual investment allowance, you're able to claim that £100,000 all in one go off your profits. So potentially that could reduce the corporation tax bill by £19,000 in that 1 year. Or if you're a higher rate taxpayer, around about £47,000 for a personal tax, sole trader, partnerships, etc. However, health warning, planning is a key. For individuals, remember you're taxed at different rates. It starts at 0% and goes all the way up to around about 47%, including national insurance. So if you could get the tax deduction at the higher rate, if postponing, spreading that investment cost using normal capital allowances would give you the tax saving at the higher rate, you may choose to spread the cost using normal capital allowances rather than annual investment allowance, or possibly using a mixture of the two. For companies, however, there's no personal allowance, for instance, so typically, claiming the annual investment allowance, even if that takes you into a loss position, is the way forward. It all depends on the circumstances. So you need to take advice in regard to that from a good accountant. As I say, many accountants I find don't always get annual investment allowance and how they can get the planning right. The question I'm often asked is, should I buy this piece of equipment or machinery? Well, the simple first question is, do you need it at all? Because if you don't, then that becomes profit. Yes, it's taxed, but you get a lot more of that money for yourself than you would from the tax deduction that you get from buying the piece of equipment that you don't really need. However, if you do need a piece of equipment, then usually the advice is to buy it before your year end. 1 day difference can mean having to wait another 18 months or so before you get the deduction on the tax. So usually buy it if you're getting close to the year end. Think about any pieces of equipment that you may well be needing. There is, however, a quirk coming up for corporation tax, where if you've got something that you might need to be replacing in, say, a couple or 3 years' time, you might want to think about replacing it or buying the equipment now rather than waiting. Why? Well, on the 1st of April 2020, it's scheduled for the corporation tax rate to go down to 17%, which is excellent. But that means if you get something and you can use the annual investment allowance now and get the tax deduction at 19%, then that's a much better situation, because when you do pay the tax, you'll be paying it at 17%. If you were to spend the full £1 million, that could be a difference of up to £20,000. Now, probably some accountants who do watch these videos going, oh yeah, didn't think of that. That's because we're having to put together the business situation, corporation tax, and the annual investment allowance, and seeing how it best fits your personal circumstances. And that's what we really like doing at Sonnet Accountants, taking the full picture, all the different taxes and how they connect. And that's how we make sure that you get as much money in your pocket as you possibly can. So if you want to find out more about your personal situation, then give us a call, get in touch. You can find out at sonnetaccountants.co.uk, Facebook, Instagram, YouTube, email, phone. You might even meet me in the street. But for now, I'm Tim Burton. This is Sonnet Accountants, the money-saving, chartered certified accountant.